When you're analyzing a stock, you'll oftentimes come across the need to enter an expected return for a particular valuation model. In this video, I'm going to show you everything that you need to know about the capital asset pricing model for stocks, including how to calculate it and how you can use this number to make better stock investment decisions. Okay, so let's start first with what the capital asset pricing model is, the CAPM. So the capitalized pricing asset model basically allows you to estimate your expected return when investing in a particular stock based on the level of risk that you're taking. It is built on the assumption that the higher risk that you're taking when making an investment, the higher the return that you should expect from it. And of course, the opposite applies. So of course, once you complete and you enter all the different numbers in the formula, what you're gonna get is the expected return on the investment that you should earn from that particular stock. Something really important to remember is that the CAPM assumes that there are two primary sources of risk. One of them is the beta of the investment or the stock that you're making, and the other is the risk-free rate. The risk-free rate is essentially the opportunity cost that you're foregoing in order to make this investment. Whereas the beta of the investment is the volatility of that particular stock in relation to the stock market. The more volatile that stock is, the more risk there is, and the less volatile, as you can imagine, means that there's less risk involved. Now we're going to talk about the capital asset pricing model formula and the breakdown. And then after, what we're going to do is I'm going to walk you through a specific example so that you can get a better idea of how this number or this value is calculated. So the CAPM formula goes as follows. First, we have the expected return on the investment. This is the result of all these different operations that you can see right here. So to start off, we have the risk-free rate. Like I mentioned, this is the rate that you're foregoing for making the investment. And usually this tends to be something like the 5-year or 10-year treasury rate. This is money that you can get basically without any risk from the government, where you're lending them money and they're paying you back interest. The next component of the formula, as you can see, is the beta of the investment. Like I mentioned before, this is the level of volatility that the stock price has in relation to the stock market. The beta formula can be calculated using the formulas that you can see right now. So there's different ways of calculating it, and of course that results in a slightly different number. The good thing though is that you don't have to necessarily calculate this value manually. You can get it from a site like Yahoo Finance. So as you can see, this is the beta 5-year monthly. And as you can see, this is the value that you would use. After the beta, we have the expected return of the market. And this is essentially what you would expect to get back in return if you just invest in the market as a whole. So something like investing in the SPY or the S&P 500. This is a value that again you can Google. So in this case, on this website, it says that it's about 10% per year. And that is right. If you look at the data for this particular period of time, it is indeed 10%. However, it can also be lower or higher. I would recommend picking a lower number, so 6.4 or 7.5 seems like a more reasonable estimate personally. But at the end of the day, it's all up to you. Okay, so now that we went over the formula, what we're gonna do is we're gonna calculate the expected return based on the formula. So right now what we're gonna do is we're gonna leave these values empty. And then what you'll see is that we're gonna populate those values using Apple as an example. But first, we're gonna calculate the formula itself. So in this case, we have that the expected return, the R. So in this case, we have that the RI, the expected return, is equal to the risk-free rate plus the beta. And this times the difference between the expected return from the market minus the risk-free rate. And this, by the way, assumes that the expected return from the market is higher than the risk-free rate, which it is. So after you do that, then you have everything set in place. Automatically, you're going to be able to get the expected return using the capital asset pricing model once we enter the different variables right here. And that's what we're going to do next for Apple. So the first thing that we're going to do is to find the risk-free rate. So let's say that we want to buy Apple and hold it for 5 years. In that case, what I recommend that you do is to go on Google, search for the 5-year treasury yield, and then you can click on one of those links. So this is the one that I usually go to. And as you can see, the 5-year treasury yield is about 4.3%. So that is the value that we're gonna enter into our spreadsheet. So we can go ahead, copy this. And now it's part of the formula. Next up, we have the beta. If you remember, there was a formula that I showed you before on how to calculate the beta. However, what I recommend is that instead of calculating this value manually, you can pick it from a source like Yahoo Finance or any other source online. So that way you don't have to calculate it yourself and you can get it exactly the way that you want it to be calculated. For the expected market return, we already Googled this value. And so in this case, what we're going to do is we're going to enter 7.5%. That is a very typical number that you would see. And then what's going to happen is that now that we have all the numbers, the formula automatically does the job. All we need to do is turn it into a percentage. And as you can see, this is what we should expect in terms of our return from Apple based on the numbers that we've entered. Okay, so now that we've calculated the expected return using the capital asset pricing model in Excel, you might be wondering, why is it that this number matters? Why are we even calculating this? And the answer is that when you do a valuation or you're trying to discount and find the intrinsic value of a company, you need a rate to use. And that is a rate that you're going to use to bring back the cash flows or the value of a company into the present. And this is the rate that you could use to make your valuation. So there's two models that are typically used. One of them is the capital asset pricing model, and the other model is the WACC. And either the CAPM or the WACC or any other model is what you would use to bring back the cash flows to the present value and find the intrinsic value of a particular stock. So now what I want to do is provide you with a tangible example. So in this case, what I've done is I have this DCF template right here that you can see, and it gets data from the income statement, the balance sheet, and the cash flow statement. And what it does is that on these lines right here, it makes different projections. And again, these are just dummy numbers, but you can change them to whatever you want, to whatever you think it's going to happen. So in this case, we have the 5-year projections. And the cool thing is that this uses Y-sheets to get the data. So if you look at the data here, you see that it's using Wise formulas from Y-sheets. We have many tutorials on our YouTube channel where you can check out how to use Y-sheets to automate your financial analysis. So what we're going to do is we're going to change this to Apple. And what's going to happen is that all of the data will automatically update, as you can see here. And so now the cool thing is that now that we know the CAPM or the expected market return that we should use, we can go to the DCF tab. And then here, there's a number that says what should be the discount rate. So there's different ways to do it. And you can see the cool thing is that this is calculating the WACC. But in this case, we're not going to use the WACC. We're going to use the CAPM. We're going to use the 8.3%. And as you can see, based on the cash flows projected, what that's going to do is it's going to take the present value of the cash flows to the present plus the terminal value. And what's going to happen is that it's going to give you a price that we should pay for Apple. Now, the assumptions are messed up, so that's why you get these crazy numbers. But you get the idea. If you have the assumptions right and you have the discount rate right, you will know according to your numbers what the intrinsic value of the company is, and then decide for yourself whether or not you want to invest in that particular company. Now you know everything that you need to know about the capital asset pricing model for stocks. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this. That's going to ultimately allow you to become a better stock market investor. I'll see you in the next one.